Hello and welcome back to The Explainer. Today, we are sinking our teeth into one of the most anticipated listings on Bursa Malaysia right now, the Empire Sushi IPO.
Now, you might remember our recent deep dive on the Sunway healthcare IPO. That one had a phenomenal debut, right? It surged as high as 60% above its IPO price on the very first day. So the big question on everyone's mind is, can Empire Sushi possibly serve up that same kind of success? Before we dive in, hey, if you enjoy these deep dives into the hottest IPOs, do me a favor and hit that like button and subscribe to the channel. That way you won't miss our next one.
Okay, let's get into it. First things first, what does Empire Sushi actually do? Because, it's not your typical high-end Japanese restaurant.
Their whole business really hinges on this multi-format model. And the real star of the show? It's their grab-and-go concept. I mean, that alone makes up a whopping 87% of their revenue. It's all about making sushi accessible, convenient, and affordable for the mass market.
And wow, have they scaled this model. As of their latest filings, they're running 143 outlets all across Malaysia. To put that into perspective, they've built this massive footprint, which makes them one of the most visible sushi brands in the entire country.
So, what's the secret sauce here? Well, it's a few key things. They really aim for that mass market appeal with localized flavors people love. And this is huge. 132 of their outlets are halal certified, which opens them up to an enormous customer base. But here's a detail I think is absolutely crucial. Unlike a lot of food chains, they directly own and operate all their outlets. There's no franchising. And that gives them total control over quality and the customer experience, which has been, pretty central to their growth story.
All right, so we get the business model. But how does that actually translate into the numbers? Let's check out their financial scorecard. And on the surface, these numbers look, well, they look spectacular. Just look at this. From fiscal year 2023 to 2025, revenue grew at a compound annual rate of over 31%. But even more impressive, their profit after tax, or PAT, just exploded, growing at over 61% a year. You can also see their profit margin ballooned from about 10.6% all the way up to 16.1%. That's some serious growth.
Now, this chart really drives home just how explosive that growth has been. But what's behind it? Well, this super steep climb is mostly fueled by one thing: opening a ton of new stores.
But as with any investment, the headline numbers almost never tell the whole story. There's a catch here that you really need to be aware of. And here it is. This is the catch. While the total revenue has been just rocketing upwards, we need to look a little closer. This table shows same-store sales growth, which is a super important metric. It basically ignores all the new stores and tells you how well the existing mature outlets are doing. And as you can see, that growth has slowed dramatically. It went from over 12% down to just 1.6%. What this tells us is that the organic growth from their core mature outlets, it's really tapering off.
Okay, so despite that slowing organic growth, there is still a very compelling bull case. There's a strong story for why investors are so excited about this IPO.
The excitement from investors, it really boils down to this. They are already a market leader with a proven, scalable, cookie-cutter business model that just works. They've got strong brand recognition, and now they plan to take all that IPO money and just slam the accelerator on expansion.
And this chart, it's basically their whole game plan laid out for you. They're expecting to raise over 152 million ringgit from this, and just look at where most of it is going. Nearly 52% is earmarked directly for opening new outlets. This IPO is, plain and simple, all about pouring fuel on that expansion fire.
Now on the flip side, every single investment has risks, and Empire Sushi is definitely no different. So let's take a look at the concerns, many of which are actually outlined right in their own prospectus.
So the bear case, it really starts with that slowing growth in existing stores we just talked about. But beyond that, their heavy reliance on shopping mall foot traffic makes them pretty vulnerable to any shifts in consumer habits. The F&B space is also, as you know, intensely competitive. And look at this last point, a pretty significant supply chain risk. I mean, relying on just 5 suppliers for almost 80% of your purchases, that's a major concentration risk.
But it's not just the operational risks that people are looking at. There's another little detail, kind of tucked away in the fine print of the IPO, that tells a very interesting story about where some of this money is actually going. So here's the deal. The founders are cashing out in a big way. Between the offer for sale part of the IPO and some massive pre-IPO dividends, they are taking a combined total of over 160 million ringgit off the table. Now, for some investors, this can be a bit of a red flag. It raises questions, right? Like, do the founders see less growth ahead, or are they simply realizing the value of all their hard work? It's something to think about.
Okay, let's pull all of this together and look at the price tag. What are investors actually paying for at this IPO price?
At the retail IPO price of 70 cents per share, the company is being valued at a market capitalization of a hefty 770 million ringgit.
Now, based on its latest annual profit, this valuation translates to a price-to-earnings, or PE ratio, of about 20.3 times. To put that in perspective, that is not exactly cheap for a food and beverage company.
And that brings us to the single most important question every investor has to ask themselves here. Is a PE ratio of over 20 justified for a business whose growth is becoming more and more dependent on just opening new stores, especially while the growth at its existing stores is slowing down so much?
So our final verdict on this IPO is neutral, or fair value. Look, there is no doubt this is a solid, well-run business with a great model. The thing is, the valuation seems to have already priced in a lot of the future success from their big expansion plans. This makes it more suitable for long-term investors who really believe in that expansion story and are willing to accept the risks that come with it.
So if you only remember 3 things from this explainer today, make it these. 1, the company has fantastic historical growth, but that slowing momentum in its existing stores is a real concern. 2, it's priced for success, which means there really isn't much room for error. And 3, keep an eye on the founders cashing out a significant amount of money from the business through this whole process.
Ultimately, Empire Sushi might look like the next hot IPO, but whether it performs like Sunway Healthcare really depends on one key thing: executing its massive expansion plan profitably, especially when organic growth in its existing stores seems to be hitting a ceiling. So what are your thoughts on the Empire Sushi IPO? Is it a subscribe for you? Let me know what you think down in the comments below, and please don't forget to like and subscribe for more deep dives just like this one. Thanks so much for watching.